And then I guess we can get started. So, welcome to the Money's Talk webinar. Today, I have a very special guest, my sister, Deborah Hamelin, and she's an insurance advisor. She is my money person. She is my second bank account. I really appreciate all of the financial knowledge that she provides. And I thought it was really important after speaking with her on some of the things that she told me on how to invest and how to really help savings, help with financial health, especially going into the new year. I think this is a great time when people start to reassess their finances and see, okay, what ways can I, one, save, but also invest so that I'm making more money in a way that a lot of these rich people are doing it. So it almost feels like free money. So I want to take the floor over to Deborah. And yes, and hopefully it's going to be an amazing talk.
Yes. Thank you very much, Rachel. Yeah, my name is Deborah and I work in the financial services. Um, I like my background, if anybody knows me, my background is actually in the sciences as well. I I've worked in the like healthcare sector as well for the most part of my like adult career. Um really doing diagnostics like laboratory diagnostics and like blood draws and everything else. Um and so I think what I do on the financial part kind of is similar to what we see in healthcare in the sense that you identify that there is a problem and then you work out ways to kind of help resolve that. Like have a like you have a diagnosis and then you have a remedy for that diagnosis that you have identified, right? Um, and so like when I first got into this, I don't think this is where I was going. Like I never thought to myself, oh, I'm going to end up in the financial sector. Money wasn't really my thing. I think money was more of our older sister's thing, right? Like our older sister Anne, she's more of like the money person. She's more of the person that, she's like, oh, your numbers go here, numbers do this, and blah, blah, blah. And so when I ended up getting into this field, I found that it was less about, oh, your numbers do this, your numbers do that. It was finding a way to make this knowledge more practical and more digestible for people and to help people understand that it's a very simple thing to do. Like it's very simple lessons to learn, right? That will enable you to kind of have more of a solid financial background, whatever your goals or dreams are. For some of us, our goals is to, have more money. For others of us, our goals is to, be out of debt. Everybody has their own different things, right? And so, for me, for some of the things that I've done personally, I was like, this would be really amazing if I'm able to share and help friends and family and the community at large around me to be able to do those kind of things and, you know, be like, instead of um instead of giving people fish, letting people fish for themselves because you can definitely gain more from being able to from knowing how to fish for yourself than to always look for somebody to hand you fish. So yeah, that's pretty much how I kind of started this journey. And it's been an interesting one so far. I am very excited about what I do, and I'm always very excited about when I am able to help somebody and what a difference it can make in people's lives. Um, so thank you again for the platform. I will see if I can. share. Am I able to share my screen so that I can? Okay, thank you. Okay, so I will try and make this a little bit interactive. Um, I know we don't have too many of us on the call, so don't feel like I'm targeting you if I like, if I shout you out. Um, so yeah, um, a little bit more about what I do. Um, I feel like it is very important to have the power of choice. So, there is strength in having more options. Um, when you look at the screen, is there any companies that you recognize? You can just shout it out to me if it's there.
BMO, Manulife, RBC Insurance. Don't really, I know TD, but not TD Asset.
Okay.
Equitable Life.
Um,
That's it.
and you also said Manulife, right? Perfect. All right. So, um, what I do is I work with all these companies. So I work with a variety of companies. We work with I think it's top five banks we work with. Um, we work with investment companies, so like Fidelity, Clarendon. We work with education companies, like financial literacy education companies, such as um, Finavo, Four Pillars. We work with insurance companies as well, Manulife, Equitable Life as well. We work with all these companies basically to provide a personalized service to each individual, which kind of comprises of that they need one to protect their income and two to be able to grow their income. So I think a lot of us are very familiar and comfortable with the idea of exchanging time for money, right? Would you agree with me on that? So, so for most of us, we're like, okay, I need to go to work, I need to put in hours. That's how I make more money. But what we fail to realize is that there is more, there is a greater potential to make more money if you're making money without having to exchange time, because there's only so you're limited to how much time. But if money grows regardless of what the time is, you have an opportunity to have an exponential growth, and also it takes away the limit of that growth. Just a second. Sorry, my apologies there. So, if we look at our income as a whole, um, is it fair to say that um, before you even get your paycheck, half of it you can assure is at least half of it is going towards living expenses? Would you agree with me on that?
Yeah.
And you know that before you even get your paycheck, what happens is your taxes come off and it's about quarter, maybe even a third of your paycheck. So the rest of it goes to servicing debts, right? So what so the goal is to look at how to minimize the amount of taxes that you're paying in a legal way and how to reduce the amount of debts because it's very difficult to kind of eat into your living expenses. For most people, that cost of living is pretty fixed, right? So we do mainly look at the things that can be variable, which is taxes and debt, right? And that way we can minimize the amount that is being serviced in that way, and we can free up some of your finances in order to create money for savings, right? Or in general, just putting more money into your own pocket, right? So for the majority of us, we um we live in the 91%. So to Statistics Canada says that 91% of us are not going to retire comfortably, or we're going to struggle to retire. If we retire, we're probably going to have to go back to work. So, and I'm sure you've seen like the greeters at Walmart, and you're like, wow, like these people, even in the winter, they're out here greeting us. For some of them, they have to keep working, right? And I mean, obviously, for some people, they love to be with the public, but for a lot of the time, people have to go back to work even when they've officially retired, right? And for the other portion, the 9%, they are either, you know, investing privately and using advisors to be able to ensure that their money grows and stretches in their favor, and the 1% who are actually wealthy. So a lot of the time, most of us in the 91%, we are living paycheck to paycheck. We are in a rat race. We're thinking, okay, we need to make more money, but we don't know how to make more money. And the more we want to make more money, the more we find ourselves going round and round in a circle. And we haven't really figured out how to get out of that spinning wheel where we're working ourselves tired, we're fatigued, and we're not seeing our take home to be more, even though we're doing more hours, or we are doing extra things. It's like the more we do, the less money we have. Would you agree with me on that? So
Yeah.
I I did say to myself that if there is a way to move from the 91 to the 9%, I want to find out what it is. And I want to take as many people as I can with me. Like, you know me, I'm not the type of person to gatekeep this kind of information. So I would definitely be sharing it with everyone that I know. And again, that's how I got into doing this, because I was like, you know, um, if I can figure out how to do it, I'm sure I can help other people figure out how to do it too. So, um, I know most of us are not architects, but I think we understand the principle of building a home. So it's the same with finances. You need to know how to build your financial home in order for you to be very stable. So, um, for most of us, the foundation starts where when we are able to earn an income, right? So whether that is, um, earning a paycheck or, passive income. So like, inheritance. And you may not get it like all at once. Maybe you get like a monthly stipend, like you get like a residual money that always is recurring coming in. But that ability to have a steady income is the basis for you having a financial home, basically. So from there, like how do you build from having that foundation? You have to look at the different ways in order to build your finances up. So once you're able to earn an income, how do you build it up? So there's different ways. A lot of people they invest in homes, right? They invest in houses, they invest in property, which is not a bad idea. Um, Although the market is quite unstable at the moment, as a lot of people will see. And so it's good to own a home. Um, if it's your primary residence, then it's something that you can keep. But if it's for income purposes, sometimes you might find that you're actually at a loss and you may not actually get any return on the money. So, another avenue of building on your on your financial home is RSPs, so registered savings plans, right? Um, this is a very good um vehicle or a very good avenue to use if you're earning a lot of money. So if you're finding that you are in a higher tax bracket and you are paying a considerable amount of taxes, an RSP is very effective because you may not necessarily see that money today, but in the long run, what you'll see is that you have money put away for when you've retired and you are earning less money, so you're in a lower tax bracket. You'll see that you'll keep more of the money. Although, if that money grows during that time that you have saved it, that it is 100% it's taxed 100%. And if you take the money out before you retire, again, that money is taxed as well. So it's a good avenue if you are in a higher tax bracket. Maybe not so effective if you're not. And then you have to be mindful of the fact that you can actually be taxed 100% on the growth of your money. Um, there is also open savings. So there are like open savings accounts, high interest accounts, um, and they kind of work just like homes. So if you withdraw money from like an open savings account, like definitely like a high interest savings account, it is subject to capital gains, just like your home would be. So your home would be subject to a 50%, you know, um, like a 50% taxation on whatever you gain. Um, and then another avenue that you can use is the tax-free savings account. So, do you know what a tax-free savings account is?
I have one. I don't know what it really does.
So, um,
I have
just out of
one.
curiosity, is
Yeah.
your tax-free savings account with the bank or with a different company?
It's with the bank, and I know like with each purchase I make in my debit, it shuttles money into my TFSA, and that's all I know. I just I let it grow, but I don't know what it does. I don't know what it's meant to do. I see interest growing in there. I don't know.
So no, I'm glad that you said that, and I'm glad that I asked because you know what, a lot of the time people they hear of these different things, but they don't actually know what they do. So a tax-free savings account is like a very good it's a very good like way to grow your money and build your financial home because as it says, it's tax-free. And so you don't get taxed on it unless you take the money out, unless you don't have the money there again, right? And it's a very good it's a very good savings account versus the registered savings plan, only because the way it's taxed is different from the registered savings account, right? The only limitation is that each year the government puts a cap on how much you can put in it because because the like the taxing process is way more attractive than the registered savings account. They have to put a cap on it, otherwise everyone would just be putting their money there, and then you know the savings account becomes redundant, right? So um but that one you don't get like in when you put the money in, you don't get you don't get taxed, you don't get taxed on the growth. It's you grow the money and it's your money to grow. It's just that it has limitations to it, right? And you don't get taxed on it until way later. So like when you file your taxes, that's when they will now tax the money inside there, right? When you file your taxes and you've withdrawn the money, then that's when the government will check and balance how much you owe in taxes. Especially if you have proposed to keep the money in there till retirement or for a certain set period of time. One other way of being able to um save money is a protected investment, um say like savings. So this actually comes in the form of life insurance. So most people know life insurance to be like, it's a set term and you pay this little bit of money, um and then once that term is over, you stop paying the money, but you never get that money back, right? Um, would you say like like let me know what your understanding of life insurance is.
Zero.
Like you have no
I know,
no
I
idea
know.
what's
When I tell you I went to school for science, I did not go to school for money. So, life insurance, my understanding is that when I die, there's money there. And so it's for my life.
so glad we're having this conversation because I know I've sat down with you before, but this must have been years ago, right? Um so I love that you said that because again, that's a lot of what people's understanding is. But there is a way to get a life insurance that you will actually be able to enjoy the money while you're alive. And again, this is a way where you can actually grow your income, you can generate wealth without having to exchange time for money. And in that sense, you are actually able to grow your money to a state where you can actually withdraw that money, utilize it. It gives you a lot of flexibility It gives you a lot of leverage, especially if you want to be able to invest in other things, say like the other um savings accounts. So like investing in property, it gives you a leverage there as well. Um, so um those that in a nutshell is your financial home. Um, you learn how to earn an income, and then you learn how to use that income to grow on its own. So you send your money to work for you. You've gone to work, made the money, and now you put your money in a I'm gonna call it a vehicle. You're gonna put the money in a vehicle where it will go to work for you. So you don't use any more time, you don't use any more energy, you don't use any more effort, you know, exchanging labor for money. The money you've put it in and it works on your behalf. Um, and then, with being able to earn an income, it is also important to be able to protect your ability to do that. So there are other things that you lay down before you put your foundation. It's those things that will stabilize the foundation, right? So, you you cover your ability, like you cover yourself against death. So say if you are married, I mean, you're not married yet, but we're looking forward to it. Yeah. We're looking forward to it. So, you know, I mean, even just the fact that you are part of, like, you have to remember, if you're alive and you're earning money, you are a commodity. You are a commodity. So if something happens to you, you're no longer able to input what you usually input. Then, there is costs that come with it. So I don't know if you know, but when you die, you have to pay taxes. Did you know that?
I did know that, but I just think that's absolutely ridiculous.
Yes. So you might be like, I don't own anything, so I don't owe the government anything. I don't owe any taxes. But if you're alive, you earn money, even if you just own a car or you have debts, the government will tax you on your life. Simple as long as you've lived, as long as you've worked, the government will tax you. Simple. So, you think about it, you go to work and you pay taxes, you spend money, you pay taxes, you invest money, you still pay taxes, right? With some of these accounts, you have to pay taxes, right? And so even in your death, you pay taxes. So the ideal thing is if something was to happen to you, like you pass away, it's important for you to kind of protect that aspect of income, so that even if you are not able to leave a surplus, at least you can break even. The people that you leave behind will not be left in debt. I mean, it's already a painful thing to lose somebody, but then also to carry another burden along with the passing of your loved one. It's a very difficult time for people. It's a very, very hard time for people. And from, teaching these financial principles, um, we have met people that have testified that, these kind of things that we taught and the solutions that we provide have had really helped them in the time of like loss, or you know illness, or you know when something bad happens to them, they were covered and they were grateful, because a lot of the time we don't think about those things when we are healthy, when we are working at our best energy, and we're working at our best strength. We don't think about those things. So um it's very it's a hard concept to get your mind around, especially when you're young as well, because you're just like, I have my whole life ahead of me. These things I don't have to worry about now. I'll worry about it later. Or and another thing, which I'll talk about later, is that when we're younger, we're not earning as much as, say, as you progress in your career, as you progress in life, you get more wisdom. Maybe you start side hustle, you build businesses, you build equity. You don't as a youth, you don't have the same earning potential that you will have later on in life. And so people think that's exactly why I can't invest in myself, or I can't build my financial home because I just don't have it. But the thing is, you don't need a lot to do a lot for yourself. You just need a little bit, and we'll go into that a little bit later. Um, so yeah, I just thought we would touch on the financial home. Most people, they use RSPs and they buy homes in order to build their financial home. But people that have managed to get themselves out of the 91%, they use all of these. So buying property is good, RSPs are good, but you also have to utilize the other vehicles that are there in order to ensure that your money is working on your behalf, if that makes sense. So far, is there like any questions? No? Okay. Mm.
Actually, I do have a question.
Yeah,
So
go
would
ahead.
these things be better done through the bank or by private, or will you get into that later?
Um, so actually we can talk about that now. Just I'm just going to stop sharing for a second. So, I mean, that's one thing that I teach clients, is that diversification is very important. So I wouldn't say pull all your money out of the bank, because the bank has its uses, right? But I have tried and tested investment with the bank and privately. And I can tell you it is like day and night. Yes. Um, so uh just a disclaimer, like all the things that I'm saying is like my own person, like most of it's my own personal views. But the principles that I teach are universal. So I'm going to use a lot of personal examples um to kind of buttress what I'm putting across. So when I first started investing, I was like 22 years old. Just a moment. Sorry, my apologies. As you know, I have kids, so I am uh yes, I'm a working mum.
My favorite human.
Yes. Yeah. I mean they're trying their best to be on their best behavior, but they have needs too. So, um, okay, let me yeah, okay, so maybe this is a good opportunity to talk about the rule of 72. So, um, I started off investments at one of the big one of the big banks. So at like 22 years old, I walk into the bank and I'm saying, I want to open an RSP. And they're like, oh my God, that's wonderful. Like that's big. So you need to book an appointment with a financial advisor and they will help you get that set up. And I was like, great. So I booked this appointment and I come in I think it's like the following week and I sit down with them and I'm like, yeah, I want to open up a RSP and I want to put as much money as I can inside it. And they're like, wow, this is amazing. And they're like, what is your goals or your motivation for starting this savings account? And I was like, I just want to save. I just want to save. I don't know what RSP. I was like, can you tell me what RSP is? Can you tell me why I'm like, what I'm doing this for? And she was like, well, I will tell you, you're so young. It's amazing that you are saving money, but we don't really see people your age coming in and, looking to save or looking to invest in the rest of it. And she was like, I don't really think RSP is suited for you. And I never really got an explanation why at the time. So I mean, I'm not knocking the bank because, banks, we work with the top five banks and they have their strengths. But at the time, um, I didn't get the type of guidance that I was expecting to get, right? Um, Fast forward, I'm gonna say 2020, like just before the lockdown, I moved my investments from one bank to the next because I was like, oh, you know, this this is uh this is not growing as fast as I thought it was gonna grow. Um, and not knowing what I know now, right? And also at the same time, my partner, he had been investing privately from the get-go. So I was like, whoa, I've been investing like a year longer than him, and his money is already caught up to mine. How's he doing it? Yeah, it was significant. So, and I think at the time I was putting in like $200 a month easily. I was just throwing it in. All right, I need to put more, put more, put more, put more. Um, and at the time, the lady said she was going to set me up with a tax-free savings account because I just finished university. I think I was like a year fresh out of university. And and she was like, don't put too much money into the account at once. And I was like, okay, I don't get why. And she never really explained that either, right? So, fast forward to 2020, I moved the money to another big bank and I saw a little bit better returns, but it still wasn't what I was expecting it to do, especially because I guess I was making comparison with my partner's investments that he was doing privately. So, we were actually looking for protection for our investments, right? So we were looking for insurance to cover our home. We had actually when we closed on our home, we were actually looking actively for like 2 years. And then that's when I eventually ended up meeting somebody that offered me the opportunity to help other people do what I did. Now, why I say that the banks has their strength is that had I not gone in that day to start investing, I probably would not have been able to purchase a home before the age of 20, before the age of 30. So my personal plan was to save up lots of money and then buy a house once I got to 30, 31. And what happened was I was able to actually buy that house 4 years earlier and still have money over. So I was able to like our house was in good condition, but we was able to furnish the house. We wasn't worried that, oh, okay, we can't put any furnishings in the house, we can't change stuff. So we was able to um build our house and make it our home. Which, in some scenarios people don't have that, right? People buy a house and they're like they have the house but they can't furnish the home, or they have to really juggle around with their finances in order to be able to just kind of make ends meet. So for me and my partner, we wasn't in that position, which was amazing, and that was because we had followed some of these principles in order to make sure that our money was doing what it needed to do. So I will share something with you now. Um, have you ever heard of the rule of 72?
Probably, but I don't.
Okay. So, let me see. Um, okay. Just a moment. Sorry, just having a small technical issue with my presentation. My apologies. Okay, think I think I got it. Okay. So the rule of 72 basically is if you take a number and you divide it by, so you take 72 and divide it by the number that you're looking at, you will get the number of years or the time it will take in order for you to um compound your money. So, um You're 29 right now, right? Perfect. So if you had $5,000 to invest today and you was to um grow that money at 4%, it will take you, let's even do this in real time. Do you have your calculator on you? Okay. I'm gonna get my calculator out too. So 72 divided by 4%, it will take you 18 years to double that money. 18 years. So um by the time you get to retirement, you would just about have made $20,000, right? So a lot of the time, that is the interest rate that the banks will give you. Like that's even like the top end of interest that the banks will give you on your money when you put it inside a tax-free savings investment account, high interest investing account. Um and for the most part, like that's not bad, right? It's something, right? Um So if you if we look at an interest growth of 12%, so when you go to the bank, they give you 4%, and then they also give you a credit card, right? And I think if you don't pay the balance off, they take like what is it, like 22%, something like that? It used to be like 19%. So the difference, so if you add the 4 and the 12, that would give you 18%, right? So if we look at the 12%, that's the difference between what they're giving you in interest and what they're making off of you when you don't pay off the minimum balance on your credit card account, right? So and this money that they've that you've invested in at 12%, that money is like doubling every 6 years, something crazy like that, right? Let's see, 72 divided by 12. Yeah, every 6 years, that money's doubling. So in like a quarter, so in like 6 times less time, because if you think about it, it if it takes them if it takes them 6 years to double your money, it took you 18. That's 3 times longer, right? So they made that 10,000 12 years earlier than you did, right? And on top of it, they're getting you to take a credit card as well. You're maxing out that balance. You're owing them that money and they're increasing the amount of interest on that too, right? So whatever they gave you in interest, they're taking it away. And so they're making money using your money. So in the same time that they gave you $20,000, they've made $320,000. Take away the 20,000 that they gave you, they made $300,000 on your money. So this was a principle or concept that was discovered by Albert Einstein. He didn't create it, but he did discover it. And he said, compound interest is the greatest mathematical discovery of all time. It is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. And this is why a lot of wealthy people, you never really see them go to the bank. All these like wealthy people, have you ever seen like a famous person go inside the bank to go and to do their daily banking? Probably not, right? So they are with these bigger banks, but they do it as private investment companies. They do it privately. So they will have an advisor come and consult them on where to put their money in which, have you ever heard of stocks? Okay, so they'll tell these people where to put their money, which stocks to use, which profiles to use, what's going to make your money grow faster, what's going to serve your money for the short term, the midterm, and the long term, right? That that is the beauty of the rule of 72. And that is the difference between investing with the bank, like as we know it, and investing privately. So with private investments, you will definitely get your money will go further for you because you can increase your money upwards of 6%, 8%, 10%, 12%, and maybe more, depending on how comfortable you are with investing, right? Um, and it takes time. I think a lot of people think that it's one of those things when you start investing, you just all of a sudden just take a whole wad of money and start throwing it. Um, I mean, I gave you my example that I was like putting 200, but some people don't have that. Some people don't have 200 to invest. I mean, I've seen people do it with just $50. And um so like the insurance vehicle that I was saying where you have that option to protect your income and then also have an investment portion. Um, for one of my kids, I only put $50 a month, and by the time they hit 18 years old, they will have already invested up to $1 million. That's the projections that we're looking at right now. Yes. So that is an instant wealth creation. And it took a sit like just a small amount of money. It just takes a little bit and it can go far. So um that's basically what the rule of 72 is, compound interest. You put a little bit, and depending on where you place your money, which is why I was saying before about the financial home, where you have different vehicles and they do different things. Where you place your money can work fast for you. It can work slow for you. It can work. Do you know what I mean? So it all depends on your personal goals. Um, I know that there are a lot of people that do like, wealth simple and that kind of stuff. But the problem with those things is it's like a self-serve. It's like going to the supermarket and doing self-serve. If you've never used it before, it can be quite confusing. Or if you don't know what you're looking at, or you don't know how to, because some of them have like loyalty cards and you may not have a loyalty card. So if it's providing you with options that you don't understand, you won't know how to use that self-serve very effectively. Um, and so that's why it's always good to speak to a professional to kind of talk you through um, you know, these processes, right? Um, did you have any questions?
No, very informative. Um, I think it does, especially with the base things that I think a lot of people want to understand and don't understand. I think you are able to kind of cover, you know, how you can start to financially increase your money, which was definitely helpful.
And another thing as well that I will say is a lot of the time when we get our paychecks, the first thing you want to do is pay off all your bills, right? I think everybody's like, oh yeah, I got this bill, I got that bill, I got that bill, I got this bill to pay off. It is so important to pay yourself first. Otherwise, why did you go to work, right? the first thing you do is pay yourself first. I know we also have our like religious people as well. So for them I'll say pay God first, or you pay the powers that be first, and then pay yourself. And you shouldn't put all of you shouldn't put all of your money towards paying off your debts, but you should be able to do like work in a strategic way so that you're steadily paying those debts off and actually getting yourself out of the hole instead of being stuck. And it's possible to do it. Um, when you sit down with an advisor, they will look at your budgeting. You know, that's that. So, it's simple things that you can do to kind of um to improve your financial health, but it's definitely something that you don't do alone, right? You definitely need somebody to keep you accountable, and also for an expert to um help point you in the right direction to things that maybe you don't know yourself, and most likely wouldn't find out by yourself either. A lot of these things that I learned, I didn't learn it in school, and not everybody's privy to this knowledge. And when I share the information, people are always very shocked. So, um, yeah, it's definitely things that um it's not common knowledge, and it's information that definitely you sit down and you share, like that information is shared with a professional, and they steer you to the things that are going to work best for your personal situation. Everybody's idea of financial comfort, financial independence, financial freedom, whatever you'd like to call it, it looks different. We all want it. We all want that financial goal to be achieved, but what it looks like is so personal to what from one person to another. And so we apply these principles, but um you do it in a very personal way. You really look at each scenario or each individual person's case differently in order to ensure that you are actually working towards that goal that people are looking at. Everybody wants something different in life, right? So some people just want to be able to have money to go on holiday every 6 months, you know. For others of us, we're like, oh, we just want to be able to buy our first home. So the aim and strategy is pay yourself first. Like these are the things that I would take home from this conversation today is, pay yourself first, have a strategy, you know, look at your budget, and then talk to a professional on how to make your budget work for you so that in the long run you are fulfilling all your financial goals and ideas in order to kind of be progressive in your goals. So whether it's, being able to have emergency funding, or you want to be able to, have money, to save for your kids' future, or save for your own future, or, to cover your final expenses when you pass, to leave legacy. Some people want to be able to give to charity, right? Others of us want to be able to go on holidays. Everybody has different ideas, right?
Yeah, I agree. Look. Hello. One of our founding members of um the Money Talks Financial. Um I do have a question because one other thing that, I was wondering was, okay, there's one thing in making money, saving money, but how do you protect what you do have?
So, so that's a really good question. So, uh, the long and short of it is insurance. Um, a lot of people don't like that word. They think it's very ugly. They think it's like a bad word. But the thing is, where we live in North America and most first world countries, um, the way the money system is worked is set up is that it's based on insurance. When you go to work, you a lot of people will ask, oh, what does the health and dental plan look like? Oh, is there an opportunity for me to do RSPs? Is there a opportunity for me to do investments? These are the ways that you this is the way that you protect your income. So, um, a life insurance is a very simple and effective way to one, protect your insurance. I mean, to protect your income, and two, to also build, create wealth, basically. It's a form of wealth creation. Um, it's put like it's investing in yourself and making your money grow, one step at a time, where the possibility was not there before, right? Um, and we work with the top insurance companies that actually, they have a good track record for paying out when, you know, you have put those things in place to protect your income. So that protection could look like accident and sickness coverage. It could look like business insurance, right? If you're a key person in your business, um, that is one way that you cover yourself. Um, it could look like home insurance, right? Mortgage insurance. A lot of the time, especially as first time home buyers, your um mortgage broker or your real estate broker will be like, you probably have to get mortgage insurance. And a lot of the time it's supplied through the bank. But the issue with that is, actually, I can share my screen again and I'll show you something. Oops, sorry. Let me just. Okay. So, um, a lot of the time, especially as first time home buyers, because they are aware that we don't know the market too well. We're very fresh and we're very new to the market. Um, they they oftentimes will, um the bank, it will be supplied by the bank, and they will do it according to the price of your house at that time. So, um the problem with that is, say if you moved houses, so that insurance that you're paying on that particular house stays with that house. You cannot transfer it. Whereas if you personally protect your income and personally protect your life, you can move, there's a flexibility to move the value and move the purpose of that protection, right? And the underwriting can be done can be done like, so if you pass away or you get ill, they can underwrite afterwards and then you don't get any payout. Whereas with like personal, um like income protection, you're most likely going to get paid out. Like I can say almost 9 times out of 10, the stats is you get paid out for those for the payouts is almost always paid out. There's very few situations where it won't be. Um, and so for that reason, um, it is better to like personally protect yourself using insurance. Conventionally, people use like life insurance. And like I said, there's two types of life insurance. There's term life. So that's the one I was saying that, you pay a small cost and it's for a certain period of time. So like say 10, 20 years. That's the average time of a mortgage is 25 years, right? So people will do like term insurance, which is okay. It's very cost effective, and with a lot of companies, you can actually change it into a permanent coverage. But having a permanent coverage is more ideal because um, it's more diverse in investment options. There is a tax deferred growth, so that was like what I was saying before with the financial home. You can grow this money and you won't be taxed on it. And the money can be paid up. So you only pay for that coverage while you're working, while you still have the ability to work. And then after that, it pays itself. And it is one of the strategies that, helps to offset taxes as well. And then there's two types, there is the like the fixed whole life, and then there's the universal life, which has a little bit of flexibility. So you kind of are able to choose where you put your money. You're able to have more control over the investment portion. Whereas the whole life, it's kind of fixed. So once you start the term, your investments are fixed, the amount that you get is fixed, but you are in agreement that you're gonna just get that fixed amount, whether things get better or worse, right? So basically that's how you protect your income, like personal insurance will help you to cover a range of things. So it can cover final expenses. Like I said, you get taxed in your death. So in when you think about it, like how many people have we known over the years that have used a GoFundMe to cover final expenses? We know a few people. We know quite a few people that, and the sad part about stuff like GoFundMe is that they take 50% of the money that you've raised to like, admin fees, transfer fees, all these different fees. They take 50% of that money from you. So you don't even get the full amount. And then, if the amount is a certain like is over a certain that if the money is over a certain amount, you're subject to paying certain taxes on it. Whereas with, personal insurance, they pay you that money tax free. So whatever it is that you have been investing in as an insurance, you get all of it without a penny being taken away, right? And that can help you cover, final taxes, final expenses. Funerals are so expensive these days. It's as expensive as a wedding sometimes. So, and most people don't think, oh my God, how am I going to cover that? How am I going to look after that aspect? Um, they just kind of think, and I think a lot of people are not aware that you pay taxes in your death, so they don't even worry about that part. It's the family afterwards that, worries about that part. So that's I like that's why it's in like that's important. And then, it covers, sorry. So then, and you know what? That's the other reason, like, insurance covers mortgages, like I just explained. You know, and then if you have the option of permanent insurance, then it also covers your investments as well. You know, people sometimes even use insurance as a way to self-bank themselves. So they use it as a way to be able to be their own bank instead of having to take loans from um the bank. They can self-insure themselves, you know. So it like a having insurance is a flexible vehicle that will allow you to protect your income and then also build it at the same time. um I think that was a bit of a long answer, but I hope it answered your question.
It did. It did. And all of these things will kind of help safeguard you during an emergency situation as well.
Yes, yeah. Although there are like in it, like say if you wanted emergency funding, there are accounts or investment accounts that you can use that would be readily available because um there is such things as like you have assets, then you have liquid assets, right? So you can have assets but you can't access them instantly. You have to wait for certain processes to happen before you need things that are liquid, right? So if you need the money tomorrow, you can dissolve it and you would get the money almost instantly, right? So there are like personal insurance doesn't do that part always. It can be used, it can be used to do that, but there are better ways of doing it. So like say like segregated funding is a way to do that, which is a type of investment vehicle that kind of has the safety jacket of insurance. So it's basically an investment. It's basically an investment account that gives you that added protection that an insurance policy would give you. So it's the best of both worlds.
Amazing. That's all of my questions for today. I'm not sure if you have anything else that you want to provide, but I think that covers pretty much. And I think Miss Esther is requiring motherly duties, but I do think that this today was very informative with kind of how to kind of set up financial success, especially for the new year. The only thing is, how do we get in contact with a financial or an insurance advisor to kind of lead us to those steps? Because I think there's one thing about hearing about it, but the next thing is actually doing something about it. So, how do we go about that?
Sorry, just had to wait a moment for the room to get quiet.
Clean.
So well, I can give you my contact information. I can put my contact information up for anybody that is interested. Just give me a second. Good job.
I didn't win it. I put it with my hand. I'm gonna test these out. I'm gonna test these out.
Sorry, my apologies. My usual my usual business thing is not coming up, so I'm just going to quickly write my information in at the end of my presentation so that you can just take a screenshot of it if you're interested. Okay, so I'm just going to share my screen with you very quickly. And thank you again for tuning in and for giving me the platform to share this with the baby mamas community. I think this is really great information to share, and it has been very helpful. I feel like as mums, we are always having to be creative with our money, and uh, be creative with the resources that we have available as well. So, um, if ever I have an opportunity to share something with a fellow mum, like I am big on sharing that information. And if there's ever a time or a scenario where I can help, I always like to lend my hand to help. So that's my information there. So my telephone number's there, and the email that you would get me at is also there as well. But yeah, thank you so much. Thank you for letting me share this information, and I hope to be able to share this information again in the near future.
Thank you so much. We look forward to the next webinar.
Thank you. All right.